Hello, my name is Seth Block. I'm the Executive Vice President of Thermo Credit and the host of the Funding University podcast. I want to welcome our panelists and guests joining us today, as well as give a hearty thank you to our sponsors, Channel Vision Magazine, RWS, Remote Work Solutions, the Funding University, and Thermo Credit. I'd like to introduce our moderator, Craig Stacy. Craig has spent his career in upper-level management as a CFO, COO, and CEO, and brings a wealth of business knowledge to the panel. Craig is currently the managing partner for Sunbelt Business Brokers. One of the primary goals of the Funding University is to help educate business leaders about smart and objective funding options. An informed leadership team can better anticipate market trends, leverage assets for growth, and prepare for the days to come. So I'm especially excited to be able to assemble this group of experts to share their knowledge with you today. That being said, I'll hand it over to Craig so we can get started.
Hello, everyone, and thanks for joining us today. As Seth mentioned, I'm Craig Stacy, and joining us today are Sylvia Blount, Associate Director for Barty Company, who specializes in buy-side and sell-side transactions, capital raising, and mergers and acquisition. We also have with us Adam Weber. He's the Managing Director at Crowd Out Capital. Adam's an expert in debt and equity underwriting and financing, due diligence execution, monitoring and servicing, building processes and procedures as it relates to the debt financing aspects. Also with us, doctorate in business administration and is an expert in technology and at high growth and startup companies. And last but not least, Stephen Hoshak is with us. He is the SBA business director with American Momentum Bank and brings a wealth of 16 years of knowledge of the SBA financing market. And so I think he's going to be an excellent addition to round out our panelists today. I'm really excited. I think today for all of you who are interested in mergers and acquisitions, whether that's buying a company, maybe selling a company to a buyer who has to finance it, and the world of financing and what's happening, especially right now at this point in our markets. I'm sure everybody has questions about that. We have a very cross-experienced panel here. We have an investment banker. We've got private equity. We have a banker, with the small and middle market. And we also have an individual with operation experience. On the other side of the table, so to speak, that helps to drive and has to secure that financing and help small companies launch. And so I'm really excited about that. So with that, what I'd like to do is just into some questions. And I think from a formality standpoint, I want to kind of hit some big picture questions and get the group to really respond to it. I think it'll be helpful for all of you to better understand sort of some big picture items. And then we'll kind of walk through some process as it relates to M&A. Today's market, the M&A processes, and then we'll conclude with some specific points. So with all that being said, let me start off with one question to the whole group, and I'll just kind of go around and cue each one of you. What are the best strategies for financing M&A right now, given rising interest rates, raising capital, a fluctuating market, and to add to that, the perspective that the Fed's not done, more rate increases are to be done. So from that perspective, maybe each one of you could give your viewpoint on where you think the markets are right now for financing M&A. How about Sylvia? I'll start off with you first, please.
Sure. Well, thank you, Greg. Nice to be here and happy to have a very interesting conversation today with all of the panelists. So to answer your question, I would say that right now the short answer is cash, most likely. So those who are cash rich will be in a good spot to really finance M&A right now. So obviously some corporate buyers that have a lot of good cash reserves, and obviously private equity funds that perhaps just raised or upped their most recent funds. But certainly the Fed increasing rates, again, by 75 basis points to still try to mitigate inflation pressures as an impact on well, not only capital markets, but also as a byproduct, middle market M&A as well. I also think that the Fed is bluffing a little bit at this point because the rate is not sustainable. The Fed is a target for the end of 2022, I believe about 4.4, 4.5. And I would say that it's probably not sustainable considering the level of debt that we're at right now with $30 trillion of debt. So that would be a very big chunk of the US budget just to pay interest, and which could happen for a short period of time. We could see that for a short period of time, but most likely it's not going to continue. And so I would say that in terms of the private markets overall in M&A, we'll probably see some defaults rising, and company will have a hard time financing or refinancing their operations. But again, this could be a great time. It could create great opportunities for companies with access to capital and a proven track record to weather the downturn for sure. So again, well capitalized with cash on hand and so forth. But again, most likely there will be fewer transactions because again, financing can be less attractive at this point. You see private equity funds that are more focused on portfolio companies and expanding those operations rather than just going into new portfolio companies. So they're focusing on financing and acquiring other add-ons for their portfolio existing companies. And also the price paid for those transactions will be lower. We're seeing overall a trend of multiples going down. And finally, an interesting trend is also venture debt, which I'm seeing quite a bit these days as obviously rates go up. And so it will create enticing opportunity for venture debt funds.
Great. God, that was an awesome answer. Thank you very much. Don, maybe from your perspective, you've got a very extensive background in startups and, helping, technology companies launch. What happens if you look at the big picture? How does that affect that market? What's your perspective on the overall, financing M&A and launching startups?
Yeah, Craig, you muted a little bit there. I think you were asking what the interest rates and the debt level is affecting technology. Well, what we're seeing in the market is, of course, what Sylvia said is that cash is king now, and more deals are being settled with cash. Private equity groups can't get funding like they could before on the debt side that makes their financial hurdles make sense. But on technology companies, what we're seeing is we're still seeing a very high turnover, especially in the SaaS market, especially software as a service. We're seeing a lot of those come to market, a lot of transactions around that, but we're seeing manufacturers less so. Those transactions are not happening because of the debt market right now, and some of the things that are happening. And again, it comes back to, can some of these companies, strategic buyers in particular, can they come up with the cash? Do they have the cash on hand to make these deals? And they're buying out, or they're beating the private equity groups because of that right this moment. Because they can walk in and say, listen, I'm going to buy you. The private equity is going to reduce your price, but we can pay your price because we have cash on hand. That's what I'm seeing.
Excellent, Don. Adam, how about you? What's your perspective on debt financing as you see the market overall? Strategies for M&A right now.
Yeah, so obviously the increase in interest rates have ripple effects throughout the market. Private equity is having a more difficult time raising debt financing from traditional and non-traditional lenders. But I would say from a overall economic and M&A activity standpoint, there still seems to be a lot of appetite from buyers. There's a lot of dry powder that has been raised over the past 18, 24 months that needs to be deployed. And so I think the biggest roadblock right now is that buyers tend to get a lot more rational before sellers do. And so you have a couple of sellers that are saying this is transitory, not to use a word that has been overused too much. But there's a lot of sellers who say that this is just a little bit of a blip, and that my business is going to start performing significantly better over the next 12 to 24 months. But buyers are looking at reducing those multiples because just the overall cost of capital has gotten more expensive. On the venture debt side, we've started to see a lot more venture debt opportunities. I think part of that is because growth equity has almost completely vanished. from what we've seen. And so and multiples have come down dramatically. So if you're the CEO of a venture-backed company and you have the opportunity to borrow money versus having to raise equity, that is a significant down round. I think you're really starting to explore venture debt. You don't mind paying higher interest rates over the short term because you believe in the terminal value of your business. So from a venture debt perspective, yeah, we're definitely starting to see more of those opportunities come across our desk.
Awesome. Thank you very much. And Stephen, you're next. Maybe you can give a perspective from an SBA standpoint now, 7A up to 5 million, that kind of smaller to lower middle market. How do you see the financing strategies for M&A at this stage, of the market?
Absolutely, Craig. Well, one, I'll agree with everybody that's spoken so far, and Sylvia, I do think at some point the rates do have to come back down, but right now it is definitely a challenge we're all facing right now. And so with a lot of our borrowers and the sellers that we speak with, the conversations of seller notes have gotten much, much deeper. Sellers should be prepared in this market to be carrying more paper. One, obviously, it's going to be a lower interest rate for the borrowers, but it's also going to help mitigate some of that cost of funds that we're seeing out in the market right now. The other piece of it is, knowing what access you have to cash to put equity into the deal, having more cash in the deal. I know it's always been said on the SBA, 10% you can get into a business, or as little as 5%. But I would say if you can put more into the deal, do so. And you can do that through accessing your 401k, converting it to a Rob's IRA. That's something that a lot of folks don't know is an ability that you can use. So just being creative with the ways that we're getting equity in the deals is important. And I think the other piece on the lender side, when we look at debt service coverage, we're now stressing that rate 2 or 3 points where, back in the day, it may have been 1.5 to 2 at most, to see what that debt service is going to look like if the rate keeps increasing. And we communicate that with our borrowers so that they can prepare for what margins they're going to want to make in the business, or see if their projections are going to be able to carry these continual rate increases that we've been seeing. So those are some things that we're doing in our side of the business.
Yeah, thanks for that overview. SBA financing is such a critical, method of financing small transactions. Since the rates have gone up in the last 90 days and, up almost 300 basis points from where they were, you could do a deal at 6.25. Now you're seeing SBA rates at 9.5 range. Do you see a significant fall off? I mean, in small transactions because of that, as a result, probably of the covenants as well.
It's 50-50. We're still seeing a lot of activity in the market. To Adam's point, there's a lot of buyers out there. There's a lot of people that are interested in leaving corporate America altogether and purchasing businesses. But I will say that the rate sensitivities become a big issue. And so what you're starting to see is some banks are starting to put a portfolio product together in their banks for fixed term for 10 years or 5 years or 3 years. They don't sell them on the secondary market. So the banks are trying to mitigate the issue and continue to keep business going. But, the SBA program's here to continue to, expand.
Yeah. Okay, good. Do you think geographically, and maybe this is something for each one of you, do you see transactions happening in one area of the country versus another? Example, is Florida more active than, some of the Midwestern states just because of demographic migration? Do some of those kind of factors play into the M&A game and debt deal from all of your perspectives? Maybe Stephen, you can comment, and then everybody else.
I can tell you recently, I've been seeing a ton of activity, definitely in Florida, Texas, Tennessee, Georgia, and North Carolina are states that I'm seeing a lot of deals come from right now. Not to say that there's not other pockets of the country that are popular, but down south, we're definitely seeing a ton here. And Florida's been like gangbusters, especially here in the Tampa Bay area.
I agree with Stephen as well. Yeah, I agree with Stephen. We're seeing similar trends in terms of the states. Definitely Florida and the states that you just mentioned, but also talking about cross-border as well. Now that the US dollar is in a different position, they're definitely stronger. There are definitely good opportunities perhaps to buy in Europe if you can find good opportunities, good targets in good markets that perhaps have already a client based in the US. We've seen a lot of those opportunities in those situations.
That was excellent. Don, you were going to make a comment. Go ahead.
Just adding on to both, but then a little bit more. Wired Magazine just came out with an article that said entrepreneurial startups in the tech community have really flourished in Florida, Tennessee, Georgia, a lot of the southern states as well. So what you're going to see is 1 to 5 years, you're going to see much more mergers and acquisitions, or acquisitions in particular, of those companies. And then the second part is, in my particular business, the number of international companies and private equity groups reaching out to me to buy companies in the US has just exploded. And I tenfold on different companies, including the Middle East. A lot of interest from Saudi Arabia right now. So what's interesting is they're coming to the US to find companies to buy.
Yeah.
So.
Yeah, excellent comment. Adam, how about you? I mean, you see the same type of geographic, activity from where you sit across the board in the debt world?
Yeah, in the debt world, we're definitely seeing more activity in places with lower minimum wage.
Good point.
California, the Northeast, all politics aside, the increase in minimum wage has really put a lot of pressure on businesses that have, hourly workforce. So, I know of several private equity groups who have said that we won't do a deal in California, not because they don't like the demographic trends, but just because it's a very difficult state to operate in. And
Right.
they're not entirely convinced that we've hit the ceiling on the minimum wage debate. So from our perspective, yeah, the Sun Belt, Texas, continue to remain really, really strong. There's pockets of the Midwest in Minnesota and Wisconsin that are seeing, I think, a lot of growth. Idaho, where there's just been a lot of migration from out of the cities into the suburbs. We've seen pockets there as well.
Great, very great. Thank you very much. That was really helpful, I think, from a big picture perspective to get a sense of what's happening in the markets. Let's kind of transition, when we think about funding and we think about mergers and acquisitions, oftentimes we try to think about process, leading up to it. Like, I want to buy a company. What do I got to do to get ready for that? And a couple questions that I'm going to kind of combine them together, but I might hit them one at a time and get each of your perspective. And that is, when I think about it, what is a lender and a creditor? What are you advising your clients? How are you guys looking at potential borrowers? And talk about the quality of borrower and what a borrower needs to do to prepare to get into the debt process to do a deal, whether they're buying a company or they're trying to get additional funds to expand their company. Maybe I think it would be really awesome to get a perspective from each one of you on that particular topic, because I think that's something that's really critical to our audience, is really understanding the process, especially right now, because it's a lot different right now than it was 90 days ago, frankly. So maybe I'll just kind of start around the corner. Sylvia, maybe you can give us your perspective on just sort of prepping clients and advising folks to, how to get ready to go to market if you're looking at doing a deal.
Yeah, that's key when you're thinking of acquiring companies, preparation, and having the right plan and mindset to go through with the acquisition. It's not just about finding the right target. That's obviously important, and there are several verticals that you may find, so many, interesting companies, but is that really a good match for your buyer? That's important to really understand early on. And, everybody can find thousands of companies to buy, but then are we going to follow the plan, and are we stick to our acquisition criteria, and are we going to really take a look at their financial situation of the target, see if it's a match with the buyer. If the target, for example, is burning a lot of cash and our buyer is healthy in terms of margins, we might want to think about it twice before going with the company, even if the business model might be a good match, especially considering the debt markets these days and interest rates. Obviously, as we all mentioned before, it's something that needs to be considered. And again, cash is king. And when you're weighing your acquisition financing options, you have to obviously consider debt as well, which is conducive to accretion, but the interest expense will decrease net income, obviously, which might have some dilutive implications as well.
qualifying, getting clients ready, getting, your company ready to go with transaction. What are the things you're thinking about prepping as you go to those lenders and debt finance?
Well, in particular, it's always about aligning your thought process and the strategy to the company you're buying. More often than not, I'll see somebody go to a lender and they'll say, I'm passionate about flowers, so I'm going to buy a flower business or something, something like that. And then the lender says, okay, well, let's talk about cash flow, and they have no clue what's going on. So a lot of the prep work has to be to really understand the strategic fit to your own thought process. Again, if you're a big buyer, you have a team doing it. If you're one person, you still should be thinking about why you're buying that business. Then the second component is just understanding if you're going for debt, 90% of it is can you cover the debt? Can you cover the ratio? Can that ratio be met? And you should be able to walk into a lender and say very specifically, very solidly that, hey, listen, I've analyzed this. This is what's going to happen. This is how I'm going to make it work for the next 5 to 10 years. That really impresses a lender in particular. After that, if you're going to cash in your 401k, so to speak, or roll it over into some equity purchase, that's great as well. But I know for a fact the IRS and the SEC like to see, that what you're doing as well when you do those type of transitions. So prep the financials, make sure you can answer the questions inside and out. That's how I prep the potential buyer.
Good. That's good. Adam, what's your perspective? What are you looking for? And you're evaluating a company that wants debt tranches, and ultimately, you're trying to qualify. Are they ready? Can they,
Yep.
will they pay us back?
Yeah, exactly. Yeah. I mean, so look, I think aside from the strategy stuff, which let's just call that table stakes, I think the thing that one of the things we really focus on is what are the current financial accounting and controls and processes. Who has access to the bank account? Who has access to QuickBooks or NetSuite or Intact? Who's making journal entries? What does the cash reconciliation process look like? That for us is the first and foremost thing. There's been a lot of adjustments that we have seen to companies' books over the past couple of years. There's been a lot of government programs, government grants, whether it be PPP or payroll tax forgiveness or restaurant revitalization fund stuff. How is that money flowing through the financials, and how do we normalize for that going forward? And then lastly, from the financial standpoint in getting everybody ready, how are you thinking about your debt service coverage ratio if the business deteriorates 10, 20%, or if interest rates increase 10 to 20%? Safe to say that we're not going to be in a zero interest rate world in the immediate future. So the idea of just taking today's spot rate and running it forward doesn't really make a lot of sense in our opinion. And so if you're underwriting to a debt service coverage ratio of say 1.15 and interest rates go up 10% and that causes you to miss, then you need to add more cushion to either less debt at close, more cash at close, or you need to do something like a seller note, which you can subordinate to a senior lender.
Those are excellent points. And I just want to sort of highlight one of the things you're talking about. One of the things we talk about now to our clients, whether it's buy side or sell side, and sell side only because there's somebody on the other side buying. So it's about getting the deal done, right? So at the end of the day, they're kind of financing too. They're concerned about the process and thinking about it. But it's when that buyer goes in, they've got to think about putting together a downside scenario. You don't lead with, the growth model. You lead with, if it doesn't hit, how low can I go? What's my debt fixed coverage, covenant? Is it 125? And today those are probably trending up. And Steve, maybe you can comment on that in a second. But I think that's really important that, if you're going to market and you're prepping and you look at a company, you got a great company, and it might look really good the last 3 years, right? Especially the last 2 years. But how is it going to look if that is inflationary rates and interest rates go up and that, decline? What's going to happen? So I think to your point, that's excellent. Steve, back to SBA. SBA has a pretty rigid process, right? I mean, of prepping, and so you probably can, elaborate a little bit. What are you looking at, when it comes to qualifying buyers and how what they have to submit, because it's pretty intense.
Absolutely. Well, I will start with, what Don mentioned, what Adam mentioned in regards to having the appropriate team. Really, you've got to have a deal team in place when you look to purchase a business, and that may be a CPA, that may be, if you're rolling your 401k, somebody that specializes in that, because it's not the easiest thing to do, and it's not something you want to YouTube. You really want to have a professional that does this frequently. So identifying your sources of your equity injection. Are they eligible under the SBA program? Identifying a lender early on, if you're going to use debt financing, I think is extremely important, because now you have a partner that when you're looking at that deal, whether you're working by yourself, you're working with a broker, you've got a lender who's going to be ultimately approving the deal, also looking at the debt service and being able to identify gaps. Looking at 2020 right now, depending on the trends, that could be a year we put brackets around, but we're going to go back and we're going to look at 19. What was the performance in relation to 21? What's the 22 trend? So just having that financial partner to be able to pull apart the numbers, I think, is important in identifying the right business opportunity. And I know it sounds simplistic, but I'll also say finding a business that works. If you're already existed, something that's going to vertically integrate well. And if not, something that you're going to be passionate about. We're seeing a lot of folks, like I mentioned earlier, that are leaving corporate America. And we want to make sure that we're placing them in businesses that they're going to enjoy, so that they can grow those companies and get the success that they're looking for. And I think the only other thing that I would add here is, when we talk to borrowers, I think one thing that's become extremely important, and it wasn't always a top priority, is the transferable skill sets. So making sure that people that are buying businesses, they've got some of those transferable skill sets, if not direct experience, very close indirect experience. We are not going to, do a loan to an attorney that had a really good spaghetti sauce recipe that wants to start a restaurant. It's not happening. So yeah, hope that's helpful.
Yeah, very, very good. I agree. That's something that often gets outlooked, and especially in the lower middle market, up to that $5 million space. Oftentimes people may have a, strong financial, position. They've worked 25 years. They have money in the bank. Maybe they have excellent credit, but at the end of the day, just because they have passion about a business, banks are not just going to loan on passion alone. They've got to see that there's something, leadership, vertical or industry experience to get a deal done. When you say that's true, they're not just going to loan to somebody because they maybe look okay, or look like they could have the potential. The banks are looking for the sure thing. So are financiers. Look,
Acquisitions are extremely hard, but the real work begins day one post-close.
Yeah.
Because you have a group of employees that that are now looking to you as the leader. You have a group of vendors who may have had certain relationships with the old owner and are now calling you. You have a group of customers who have associated with the old owner and his face with the business, or her face with the business, and now it's yours. So passion is good. Passion is what will get you up in the morning, and make you excited to go to work. But really, I would encourage anybody who's thinking about making an acquisition to really imagine it's not all, Wall Street buying a company and talking to bankers. As great as we are, it's not always that fun. A lot of times it's just sort of blocking and tackling. And unless you really love the business and love the people that you're working with, I don't think you should do it.
One thing that's interesting, and I'd like to get each of your perspectives, it's something that, oftentimes banks, financing companies, everybody, that they want to understand your leadership team, which is extremely important. They want to understand your vertical. Is it a cyclical industry or not? Clearly your financial position. They want to know what your, budget and forecast for the next 3 to 5 years. What's interesting, especially in smaller deals, I never see a bank say we require an integration plan. Like, in other words, what happens, to your point, Adam, day one after, for the next 180 days, 190 days, whatever that period may be, 3, 6, 9, 12 months. What's your perspective? Have you guys seen that happen? I mean, obviously big companies, large M&A groups, they do it. That's in private equity. That's the nature who they are. Yeah. But I'm thinking more about in our lower middle market, maybe you guys have seen it, but comment on that, because I think integration plans for like our participants and people who are looking for financing, it's really important. That may be more important than the deal itself, frankly. So Adam, maybe you can comment and then we'll go around the rest of the panel.
Yeah. And we agree. So, part of every acquisition, whenever we make an acquisition, part of our strategy, part of every memo that we put together is what's our 100-day plan. And for us, it's really, really important because, we're not just financial engineers, we're operators at our heart of hearts. So that's really near and dear to us. Where we see companies typically fall down on this front, or where this becomes evident, is when you talk about post-closing financial covenants.
Yeah.
So for instance, in all of our loans, we require monthly financials. And if you cannot produce monthly financials within 30 days of the prior month end, we have a problem. That tells us that you don't have, as Stephen mentioned, the team in place to close the books in a reasonable amount of time. We're not asking for you to close the books 3 days after the month end, but 30 days. When you're talking about getting proper insurance coverages and making sure that loss, the loss name goes to the lender at first. If you don't have the right insurance, you're not going to be able to meet that covenant. All of the environmental and governmental approvals that you need, whether it be OSHA or ERISA, if you can't sign off on those affirmative and negative covenants, then that tells us you don't have an integration plan ready. So we agree, but I think the way we see it typically expressed is through those affirmative and negative covenants that are part of the loan agreement.
Yeah, good, great. Don, maybe you can give your perspective, as you've probably been part of a lot of that.
Actually, yes. And I just finished teaching a class on it. Integration is so key to the success of a merger and acquisition. It's unbelievable. It's the number one way it fails. We were talking about, for example, and I got to caveat this a little bit, that it depends on the size of the company. Obviously, if you're buying a really small company, the banks and the financiers are going to look a little bit, but they're assuming it's a smaller organization. But larger ones, I've seen it over and over again. For example, the leader doesn't come in and immediately start talking to the sales team, for example, and half the sales teams walk out the door. And so that's why it's critical. Then you start with the HR team and the IT team. That intellectual capital, if you don't go in there and take care of that right away on day one. Now backing that up, I know the banks look at that. I know they will look in and say, hey, listen, what is your plan for transitioning this 50, 100 employees and making sure that you do it right? So I can't stress enough how important that is.
Yeah, that's good. I think those are excellent. Sylvia, your perspective on it from where you see it.
Yeah, I agree with Adam and Don for sure on the integration plan needs to be done as early as possible. And also it has to be a smooth transition between perhaps the due diligence team and the integration team, of course. And one thing that I would say maybe a lot of buyers tend to forget is the integration cost itself. Not only having an integration plan, but also when you're valuing a target, understanding really what are the costs associated with integrating this company in our business. And that would obviously eat up the synergies, the projected synergies.
Right. Excellent. Stephen, how about you at that level of, SBA and 7A, how do you see the importance of it? I mean, I know that you go through a pretty rigorous process of qualifying a lot of things and asking about those, but, maybe along the lines of what Adam mentioned, the negative covenants and such, maybe some of that's the catch-all, but how do you guys view it from where you sit?
I think integration is a key part of due diligence. It's something that everybody should be looking at in the process. And I can tell you, within the SBA program, we don't have covenants, which in some ways is a benefit to the borrowers and sometimes a detriment to the financial institutions. But what I can say is, as we go through the underwriting process, there's a few things that we want to know about. One, we want a fully executed business plan that identifies the current leadership team that's in place, the new leadership team that may be coming in, who's going to hold what role in the business, and what employees are going to be staying on. Is there going to be some sort of employment contract with the key employee? Are there any licenses that are required to operate within that business that need to be assigned or transferred prior to closing or at closing? So we want to make sure those things are done. The other way that we help our borrowers be successful, post transition is we identify in the loan process what permanent working capital needs they're going to have. Is there going to be a marketing strategy that needs to take place in the first 30, 60, 90 days? Are there some key hires that they need to make to scale the business to the projections that they've provided? So, we identify a lot of those things to give our borrowers the best chance at being successful. And then on the back end, from an underwriting perspective, we also look at post-closing liquidity. If there is a 20% decrease in business, do they have cash in the bank outside of the permanent working capital that we've laid in, cash that's within the business that can help support that? Or if there's a rate increase also in that same spot. And then, as I mentioned earlier, we stress the debt service coverage to make sure that they're insulated for those interest rate increases as well. So there's a lot of things that we do. The SBA process is very intricate in that aspect.
Good. And those were excellent comments from each of your perspectives. And I think probably allows us, we kind of hit some of the process standpoint. Let's kind of transition now into some different types of M&A financing and what you guys are seeing in the marketplace. One of the obviously popular concepts, we're always talking about, doing M&A with private equity. You often hear the term financial sponsors. So somebody wants to buy a company, they've got some experience, but they need more capital brought to the table in the form of whether it's equity and some other form of debt. Just tell us a little bit about each of your perspectives with private equity as a use of financing an M&A transaction. What if somebody wants to do a larger deal? They know they don't have enough capital, they don't have the equity within their business, and they want to partner with a private equity firm. How should they think about it? How should they go about it? Each of you probably have a different perspective, so we really want you guys to share with the audience your perspective. Sylvia, why don't you start off first?
Yes, I see this more and more these days, talking about corporate buyers and perhaps fundless sponsors or independent sponsors. They might coordinate a financing with the private equity institutional financing party. And again, corporate buyers can bring a private equity sponsor they can bring them in as a minority shareholder to kind of bridge the gap and finance the acquisition. It's definitely easier, faster, and it also skips the regulatory requirements for example, a stock offering or a debt offering. If you have to do a placement or a follow-on, for example, to raise that financing, the process is obviously cumbersome, costly, and not so efficient. But when you bring in a private equity sponsor, for example, you only have to deal with one investor, first of all, rather than multiple, maybe smaller investors, which is definitely a benefit. I would say that most buyers would agree with that. At the same time, private equity sponsors might want a board seat. Most likely they will want a board seat and also want to see the company on a path of growth and monitor closely the performance of the company, keeping track of everything that's going to happen after the transaction has been consummated. But definitely it's a great tool that a lot of corporate buyers and maybe, again, independent sponsors can use to finance the acquisition.
Mm-hmm. Great. Don, what about you? What do you think about private equity as a vehicle of financing, especially a growth entity or a venture capital partner to help get a deal done?
Definitely, I've done a few deals with it, and it's definitely a way to get capital in the door. I would advise ahead of time that start doing your research even earlier to find the right group and the right company to fund that. The reason being, a lot of private equity groups, they may not do it. And if you're chasing them down, trying to figure out if they'll fund your deal, that's a waste of time. So you try to get in with a few groups that'll fund deals, and they get to know you. As a CFO, I tend to have some clout when I walk in the door. But if, as Stephen mentioned earlier, if a lawyer walks in the door and says, I want to buy a pasta sauce company for $20 million and I need 15 from you, they're probably not going to fund it as fast as they would if they know what you're doing. So you got to be prepared ahead of time, make the contacts ahead of time.
It's good, Don. Adam, what's your perspective?
Yeah. So on the debt side, we've worked with fundless sponsors or independent sponsors. From our perspective, we're looking for the independent sponsor we're not just buying a company for them. We're looking to basically partner with them And we expect them to be a subject matter expert, and we expect them to be a leader of the business going forward. On the equity side, I think what's really important is that you have the CEO or the, the individual and the private equity, their incentives are completely aligned. It's really, we've seen it go sideways when independent sponsors have partnered up with the private equity firm that have put them in maybe, a different structure, or they've used debt financing to basically get a free call option on the business. So I echo what Don said. It's important for individuals to go out, meet with the private equity sponsors, do a lot of homework, ask for referrals, do some sleuthing on your own, and find out if they're going to be because look, it's a marriage. I mean, it is a marriage, and most businesses are not a 3 to 5 year exit. Most businesses are a 7 to 10 year marathon. So it's really important that you like the people that you're working with, and they're going to be trustworthy partners when there's a bump in the road.
Great comments. And Steve, what I would say is, obviously you're probably not bumping up against that, but today you've got a couple verticals that are really consolidating pretty aggressively. Some of the trade spaces like HVAC and plumbing, and some of these areas where the businesses might be in that 3 to 5 million range, and you've got aggregators there. So I'm sure companies that you guys as a SBA lender can finance. You got these private equity firms that are whether it's minority or majority, they're spinning in and taking out deals to roll up. What's your perspective on private equity as a perspective on financing?
So I don't think we've ever competed with private equity more than we have right now. I mean, it's been
a good point.
Yeah, and especially when it comes to the trade companies, it's left and right. And when you see a market that's not doing very well, it makes sense for these firms to come in and deploy the capital into the small businesses that are the backbone of our country. So it makes sense. So I'd say that we see a lot of competition there. And I'd also say that, banks have a certain propensity to lend when there's collateral, and when there's not enough collateral, that's when banks get a little bit, antsy. They don't want to do those loans. So one piece of this, I would say, when you're talking with your SBA lenders, find out what their unsecured tolerance is right off the get-go, because if it's $1 million and you're looking at a $3 million business, you're probably not going to get the deal done. And when you're starting to look at businesses where there may be $4 or $5 million in blue sky, that's when it makes sense to start having these conversations with the equity groups. And then, just as you would interview a lender, you need to interview them. What are their holdings? What are their goals? What are their what are they looking to do over the next 5 to 10 years? Because it is a marriage, and it's got to align well. I think the values have to be right in lockstep.
Good deal. So, it's interesting. We got a question from our audience, and I want to kind of pose it to you. I'm going to probably summarize it a little bit, but one of the questions, what I think the participants getting at is, how much are banks focused on how much liquidity now exists post-close a deal? In other words, how many turns of EBITDA do they have? How much working capital, lines of credit, unencumbered accounts receivable? And is there kind of a rule of thumb of what type of, capital, some ratio, so to speak, that you guys think you've experienced in transactions and what you see in the marketplace today for debt? Maybe you guys.
Boy, is that a loaded question.
I know it is. It's an extensive one, but I would just answer it in the simplest way from where you guys sit and how you think about it.
Absolutely. So I would say it really is business and almost industry specific to what we like in capital within the business, whether that's cash that's been left in through the acquisition or it's been financed into the loan, is what is a more appropriate number that we're looking at when we look at debt service coverage. So I hope that answers your question from the banking perspective.
Yeah, no, that's good. There's
one thing to think about is, what is the nature of the working capital of the business? So, there are some businesses that have very favorable payable terms. And if you can extract an extra 10, 15 days on your payables, then you may need less cash buffer. But on the other hand, if you have an incredibly long cash conversion cycle, if you're talking about inventory that turns, 2 times a year, and you're talking about AR that's on, net 60, net 90 days, then to Stephen's point, 6 months of net working capital as a reserve is probably about right. We've seen it solved a couple different ways. One is through a revolver that's undrawn at close, but it has availability. And then what we've also seen, and I think maybe Don mentioned this or Stephen mentioned this, is you may want to put some of the excess cap or some of the capital that you think you're going to need into a seller note and leave more cash on the balance sheet at close, because we don't know what net working capital trends are going to do over the next 90 to 120 days.
Yeah, that's great. Great. Don,
Craig,
your thoughts?
if I can, I'm smiling here because I have a funny story about this that'll show it. I had a buyer go out and he was looking at a business, and he had experts define what the net working capital was needed, and he decided to drop that down. When he went to the bank, he dropped the number down quite a bit so he could use some of that cash for the purchase price. Well, every single bank rejected him. And it wasn't until he actually went back and said, "Why did you reject?" And the banker said, "Well, listen, you've got 5 experts in your proposal to us that said you need 5 times as much, but yet you're coming to us and saying you don't need it." So listen, be prepared, talk to the experts, make sure you walk in there with a solid number for net working capital before you go to the banks and embarrass yourself, I'll say.
Yeah, excellent point. Sylvia, your thoughts?
Yeah, I agree with what everybody just said. And I would say what I'm seeing on my end is a rule of thumb. The company should probably maintain a coverage ratio of 4 times and above. So in terms of EBIT, covering the interest expense. And I would say that, yeah, that's most situations that I've seen when it comes to acquisition financing, with maybe a bit more conservative lenders. Maybe you find more aggressive lenders that could go a little below that, but that's kind of what we're seeing in the market.
Yeah, it's good. And it's interesting because that's another one of those sort of like, I was talking about integration being an item. That's another one of those areas. Now, banks do look at it. Banks particularly focus on liquidity and availability, but that's an area that, especially now, you could think 1.5 terms is, that's sufficient minimum working capital of EBITDA to kind of ride out and run your business. But in reality, what you just said, 4 times, you may need a multiple of it, because you could burn through it really quick. Depending on the business and concentration and vertical sector, you could have a sector that just plummets. Oil and gas is a classic sector that gets, cyclically, especially today. I mean, they're at this crazy high of 125 a barrel of oil. And now, in literally 90 days, they're at 85. Think of it. And if you just go back, think about a year, 18 months ago, it was in an inverse. It was inverted. It was negative. And so it's just like, when you think about the velocity of some of these sectors, and then you go to bank finance and you think about doing deals, it's just crazy what can happen. And so being liquid and really thinking about it, because you don't want to be sitting across from a bank in a workout scenario, or going back to the topic, we're talking about, financial sponsors and private equity. Sometimes, they loan to own. And so you take money and you don't hit your covenants and you can't get out of it, and you can lose your company. And so you really got to be mindful of your working capital, especially right now when the market go back and the market's going crazy. And you got a 5-year growth trend, maybe a little bit different, but right now you got to be sensitive to that. So great topics, great comments on that. I'm going to shift a little bit now. I want to get a little specific on some stuff, and let's talk about mezzanine financing. Is mezzanine financing, quasi equity, and maybe some of you can talk about what that means, a good idea for your company to consider, maybe like right now? Higher interest rates, maybe you can carry a little bit more debt because it looks like the acquisition covers it. But give me some comments and thoughts based on each one of your experiences on mezzanine equity, or that second tranche equity, quasi debt equity. So let's start off with you, Adam, because that's your area of specialty.
Yeah. So we've never seen more second lien and mezzanine opportunities over the past 7 years than we've seen in the past year. Largely, I think that's because senior lenders, with interest rates so low, senior lenders were willing to stretch up to 2.5, 3, 4 times, which really kind of priced out second lien and mezzanine. There was just no need for it. So in a traditional 10 times deal, you were looking at, a senior lender that was willing to provide 4.5 times, and the equity was coming in at 5.5 times. Now, with banks starting to retrench a little bit, you're seeing banks come in at maybe 2.5 times, and then they're looking for that second lien debt for additional 2 turns, and then or mezzanine for that additional 2 turns, and then you have equity filling up the rest. So we've seen more second lien and mezz opportunities than we have in a while. I would say what's important for business owners or acquirers to think about is what is the cash pay versus payable in kind component. Cash pay on these mezzanine pieces can really put a lot of stress on your cash flow. But if you're able to have a PIK toggle and move it into sort of a non-cash expense, that's really favorable. And then I think the other thing for buyers to consider is what is the equity dilution, or what are the warrants associated with that mezzanine financing, and how does that fit with your overall control of the company?
Great, that's excellent. Thank you. Let's go to Don. Maybe your perspective on mezz and how you've seen some of these second tranche, debt layers getting used in today's activity.
Well, they're definitely an alternative, but I'm going to say honestly that I advise my clients not to approach them, mainly because right now the uncertainty in the market in the next 12 to 18 months may cost you more than just the cost of the debt. I apologize, Adam, if that takes a couple of customers away from you, but
no, it's okay. That's okay.
But I'm honest when I sit down and look at them and I say, listen, you're adding way too much risk. And that's what it comes down to. It's not so much about the cost. It's just, as you pointed out, Adam, earlier, and Sylvia, you did as well. Just what is it going to look like in the next 12 to 18 months? The markets, the debt, the interest rate, and so on. I'm predicting it's still going to go higher. So I tell them, listen, the risk is too high for that. Let's look for some alternative lending sources that aren't quite as high as mezzanine. So my point.
Yeah, I have to agree on our side in terms of acquisition financing. We're seeing, yes, still pretty decent levels of mezzanine financing, but also other instruments and just your usual senior debt or maybe seller notes as well. Still lots of earnouts in terms of the overall structure of the deal, and we're working, myself, with a lot of buyers that are cash rich, and that's typically how we want to really position ourselves to work with those type of buyers that can tap into their cash reserves and close the transaction that way.
Got it. That's good. And Steve, what I would say in your world is let's not think of mezz financing. Let's think of seller financing. Talk about, in an SBA world, what happens now to seller financing. And maybe you could also, for the audience, talk a little bit about the terms, because I think a lot of times when people go, they think about SBA, this is the way I can get a deal done. They want to lend money, and then we're going to get a seller to come in and they're going to finance it. But that the terms of that seller financing are unique, and buyers don't know it and sellers don't know until it's like at the 11th hour. And then they're like, oh, I'm not doing that. I'll get my money for 5 years or 10 years. Maybe you could talk about that a little bit.
Right. So yeah, seller notes, again, have been a huge topic of discussion in our world. And a few things that I'll say right off the top. One, you can have as many seller notes on a deal as you want. There's no limit to them. It's not, most people think it's a one seller note deal and that's it. So we can structure several seller notes to meet the needs of both the borrower and the seller. I'll tell you that when we look at equity injections, if a seller puts a seller note on full standby, then that seller note can actually become equity into the deal, which can help, again, preserve post-closing liquidity for our borrowers. Full standby, just for everybody on the call, that means that typically it's going to be 10-year term, 10-year amortization, and there are no payments to be made to the seller during that period of time. And that seller note, as well as any other seller note, is always subordinate to the SBA loan. So, for instance, depending on what the seller's needs are, we can do 5% of of the seller note on full standby, 5% with principal and interest payments, 5-6%, whatever's agreed upon. We can do a 3-year term. We can do a 3-year term and amortization. We can do an interest-only seller note. So there's a lot of different ways we can do it. And really what dictates the seller note are a few things. How much collateral do we have in the deal? The seller note's going to help mitigate the risk to the bank. The other piece of it is, what's the post-closing liquidity look like, as I mentioned before, and what's the debt service coverage look like? Do we need a seller note on interest only or full standby to make the debt service count? Because if it's going to be utilized as debt, it's got to be factored into the debt service calculation. If it's going to be counted as equity, we don't have to do that. So I know that's a lot for the seller notes, but there's a lot you can do with them. It's not just one way.
It's been a great hour, and I want to just give each of you about 30-second conclusion. Maybe there was something we didn't talk about you think needs to get made today as a point, or just a conclusion statement. Would be awesome. Start off with ladies first. Sylvia.
Sure. Again, I think that there's going to be lots of good opportunities moving forward, not only for the private equity sponsors, but also for corporate buyers. We're seeing definitely big trends on the buy side compared to sell side these days. As it was mentioned before, lots of sellers are actually maybe rethinking their strategy, maybe holding off on going to market until Q1 of next year, but that at the same time, there's still lots of good opportunities for buyers that can work with those sellers that are ready to go and see good opportunities in working with those buyers. And again, overall, talking about the market, a lot of people now compare what's been happening to the 70s with interest rates going up and then high inflation. At the same time, we have to keep in mind that back then we didn't have as much debt, so that's a big factor to keep in mind when transacting and looking at the future of middle market M&A going forward.
Excellent point. Don, table to you.
Well, I'll tee up, or I'll play off of what Sylvia said and add that there are a lot of companies out there that may have survived through COVID, that they're still willing to sell, and they're out there in the market. The second part of that is there are cash rich buyers, and if you can get a few of them in the room and they can bid up the company, that's a good thing. But also some of the companies out there that we see a lot of activity on are ones that maybe they want to get out before a full-on recession hits. So one of the things you want to do, the buyers that are coming to me are saying, listen, don't look for companies that will be severely impacted by a global recession. But what I'm saying is maybe the time to bargain. So there's a lot of bargains out there, I believe, for the buyers.
Great points. Adam, your thoughts?
Yeah, look, I would just say to anybody who's thinking about buying a business, don't cut corners. This will maybe be one of the biggest decisions you make from a financial or from a business perspective all year, depending on your type of business. And it's really, really important to hire the right people, talk to as many people as possible, really ask a lot of questions, and make sure that you're doing the right thing for the right reasons. There's nothing worse than, and Don talked about it, there's nothing worse than a failed acquisition. It's crushing to the finances, and it's crushing to the culture of a business. So when you're looking at these opportunities, talk to people like Sylvia who've done this a bunch, talk to Stephen, talk to Don, ask people questions, get advice, and really make sure that you're doing it for the right reasons.
Well said. Well said. Stephen.
I'll just end with, again, deal team. Make sure you've got the right people on your team when you're going to look to purchase a business. Make sure that you are looking through the financials extremely close, asking lots of questions. I don't think you can ask too many questions when, again, you're getting into a financial marriage when you're buying a business. And when you're talking to lenders, interview several, speak to different people, find out what their goals are, how their shop works. Are they a PLP lender, meaning that they're designated by the SBA to be able to make loans on the SBA's behalf, or do they have to go through the SBA? It helps to know what the time frame is going to be to close a loan, and just make sure that you've got good partners in the process as you go through it.
All right, great. Well, thank you to all the panelists. You guys did an outstanding job, and really, I think, helped the the audience and participants, better understand how to deal with M&A transactions in today's environment from a financing. So I want to thank everybody who attended today, our panelists, Sylvia, Adam, Don, and Stephen. We hope you all in our audience found the Opportunity Funding useful and informative. We'd love to hear your thoughts. And so please fill out our post-event survey, which will be emailed to you shortly. Be sure to include any suggestions about topics you'd like to see and discussed, or ways we can help meet the goals of your informing business leaders about funding trends. Each one of the things that we talked about today were so helpful and so different, that hopefully that really benefited you. Again, thank you to our sponsors who made this event possible. We appreciate the support from Channel Vision Magazine, Remote Work Solution, the Funding University, ThermoCredit. If you'd like to listen to the recording of today's events, it will be posted on the ThermoCredit, Funding University, and Funding Strategies websites in the next few days. Thank you for joining our conversation today. We hope you have a great rest of the day, and we look forward to possibly seeing you on the next version on December 8th. Thank you very much and have a great day.